The IMF has sounded an alarm about the risks posed by the booming private credit sector, commonly referred to as shadow banks, with $2.1 trillion involved. These lenders provide quick, flexible, and confidential borrowing options to companies, considered too risky for traditional banks. However, lax regulation coupled with the potential for economic downturns could lead to severe consequences, including defaults and significant losses. The IMF warns that the interconnectedness and opacity of these deals could amplify risks across the broader financial system. While immediate risks seem limited, the IMF urges regulators to adopt a proactive approach to oversee this sector. Additionally, the IMF cautions the Bank of England against leaving interest rates too high for too long, especially considering the large share of UK homeowners with fixed-rate mortgages, which could lead to a sudden drop in consumer spending and potentially trigger financial instability. When central banks like the Federal Reserve raise interest rates, it affects the cost of borrowing money for banks and financial institutions. As interest rates increase, it becomes more expensive for these institutions to borrow money from traditional sources, such as central banks or other commercial banks. In response to higher borrowing costs and potentially tighter lending conditions in the traditional banking sector, institutions may look for alternative sources of funding. One such alternative is the private credit sector, which includes a variety of non-bank lending institutions such as private equity firms, hedge funds, and other types of alternative investment funds. Private credit providers often offer loans with terms that are different from those offered by traditional banks. These loans may be structured to be more flexible, with customizable terms and conditions tailored to the borrower's specific needs. Additionally, private credit providers may be willing to take on higher levels of risk in exchange for potentially higher returns. In times when liquidity in traditional lending channels is drying up due to rising interest rates, institutions may turn to the private credit sector as a way to access the capital they need to finance their operations, investments, or other activities. This shift toward private credit can help institutions maintain their access to funding and liquidity in an environment where traditional sources may become less available or less attractive. However, it's essential to recognize that while private credit can offer benefits such as flexibility and access to capital, it also comes with its own set of risks. The lack of regulation and transparency in the private credit sector can make it challenging to assess and manage these risks effectively. Additionally, the interconnectedness of the financial system means that problems in the private credit sector could potentially have broader systemic implications, as highlighted by the IMF's warnings about the systemic risks posed by shadow banking activities. The International Monetary Fund, IMF, has raised red flags regarding the looming specter of a new financial crisis, driven by the perilous lending practices pervasive within the shadow banking sector. This cautionary note follows the proactive stance taken by the Bank of England, which has initiated a comprehensive review to assess the inherent risks associated with private equity investments. Delving deeper into the IMF's concerns, the organization underscores the systemic vulnerabilities emanating from the opaqueness characterizing the world of private credit, estimated to be a staggering $2.1 trillion in size. This burgeoning sector, fueled by the prolonged era of historically low interest rates, has emerged as an enticing avenue for companies deemed too risky for traditional bank loans, yet too small to access public markets. However, the absence of robust regulatory oversight in this domain has sounded alarm bells, with the IMF cautioning that a downturn in the economic landscape could lay bare these vulnerabilities, potentially precipitating a wave of defaults and substantial financial losses. Furthermore, the IMF highlights the intricate web of interconnectedness that permeates the shadow banking realm, with both public and private pension funds heavily invested in private credit markets. This symbiotic relationship accentuates the ripple effects, extending the risk beyond private lenders to encompass broader swaths of the financial ecosystem. Against this backdrop, the IMF's admonition coincides with the Bank of England's meticulous examination of the financial stability risks intertwined with private equity ventures. Of particular concern are the valuation dynamics of assets held by private equity entities, the leverage ratios underpinning these investments, and their intricate interlinkages with commercial banks and institutional investors. Notably, some of the United Kingdom's corporate giants, including retail stalwarts like Asda and Morrisons, now find themselves under the stewardship of private equity firms, further underscoring the pertinence of the Bank of England's scrutiny. While acknowledging that immediate stability risks may seem contained, the IMF sounds a cautionary note regarding the opacity shrouding transactions within this sector, making it arduous to accurately assess potential losses. Consequently, the IMF advocates for a proactive regulatory approach, urging authorities to bolster supervisory mechanisms and conduct comprehensive reviews to mitigate systemic risks effectively. In a parallel vein, the IMF's scrutiny extends to the interest rate policies pursued by the Bank of England, with a particular focus on the potential ramifications of maintaining elevated interest rates over an extended period. Given the substantial proportion of UK homeowners locked into fixed-rate mortgages, the imminent wave of mortgage rate resets poses a significant risk, potentially exerting downward pressure on consumer spending and catalyzing financial instability. The IMF's comprehensive analysis serves as a clarion call for policymakers worldwide to remain vigilant and address the evolving challenges posed by the shadow banking sector and the impending mortgage rate reset. It underscores the imperative of proactive regulatory interventions to safeguard against the recurrence of a financial crisis, emphasizing the need for enhanced transparency, robust oversight, and prudent risk management practices.